Welcome, everybody, and thank you for joining us for this episode. We got a really special guest on today, post-halving series going on right now. Avi Felman, he's head of trading, BlockTower Capital. I'm here with my co-host, Ryan Gorman. Avi, really glad to have you here. The first thing I want to do, especially in this regulated market, is if you could delve into a little fine print disclosures for us on this interview as we go into it, as well as the most important question that I always love to hear from everybody is the road you traveled prior to crypto and how you got in here.
Yeah, for sure. Well, thank you for having me, Ryan and Alex. Really appreciate the invitation to the podcast. Yeah, just to get some fine print out of the way, I am the head of trading at BlockTower Capital, a cryptocurrency investment firm. But all of my opinions that are expressed here are not the opinions of BlockTower Capital. They are my own personal opinions. So just to get that fine print out of the way.
I'm not sure. Do you do fine print like instead of a normal voice, you go, just so you know, none of my opinions are BlockTower Capital. Like a commercial, like
no, exactly like a drug commercial where they give you all the side effects. Just so you don't know.
Or super fast like commercial at the end when they're describing the lease terms. Just motor.
Yeah, exactly.
All right, so tell us the journey. How did it happen? What were you doing here? How did you catch the crypto bug? And how did you end up being head of trading at BlockTower Capital?
Yeah, so a little bit of background. It's actually not super long. So in late 2016, early 2017 is when I first really fell down the crypto rabbit hole. I was in university at the time, and one of my really good friends had recently gone down the hole and was introducing me to the concept of Bitcoin at the time. And I found it fascinating. I was studying chemical engineering at Washington University in St. Louis, but my passion was always economics, business, and finance. That was what I spent most of my time on outside of my core studies. And I really enjoyed thinking about Bitcoin in the context of that specifically. So in the context of economics and in the context of finance. And at the time, I was really interested in trading as well. So I'd obviously been punting stocks on Robinhood, as your normal college student does. And I saw Bitcoin as an opportunity to play against people that were more on my level, right? So I looked at the cryptocurrency markets and I saw a lot more inefficiencies in the cryptocurrency markets than I did in the traditional markets, right? As a 20-year-old, 21-year-old, I'm not going to be beating Citadel trading equities. And I'm probably not going to be beating Optiver trading options. So really, if I wanted to trade, I would look to the cryptocurrency markets. And that's kind of how I really fell down the hole. And throughout 2017, I took a stab at creating strategies to attack the market, to trade the market. And by late 2017, I had actually graduated in mid 2017 and ended up working at Capital One as a business analyst for 6 months. So I was doing data analysis and data science for them. But in December 2017, the market went wild. My strategies were doing all right. I was trading on the side, and I decided to leave Capital One and just go full time into crypto. And so that's really how it started. In December 2017, I top ticked it. I quit my job. And I jumped into the greatest bear market in crypto history. Actually, that's not true. 2015 was a lot worse. But so I jumped straight in, and along with two friends, the two friends who introduced me to cryptocurrency, I started a research and investment firm called Ledger Capital. And so Ledger Capital was focused on quantitative evaluation of the cryptocurrency markets for two reasons. One, we provided research to other hedge funds. And two, we traded our own internal book. And so we ran that for about a year and change. And then in early 2019 or late 2018, I was picking up on the derivatives market. So I noticed that the derivatives market in cryptocurrency was really, really picking up in a big way. And my thought process around it was, I think that's going to be the next big wave. I think derivatives are going to be the next big wave. And I think institutionalization of this asset class is going to be the next wave. And so in the beginning of 2019, I joined a firm called Wave Financial, leaving Ledger Capital behind, because they had a vision of a world with institutionalized cryptocurrency products. So they built an index fund which I helped build. And then along with somebody named Ben Tsai, who's the president of Wave Financial, I built a product called the Wave Covered Call Fund, which basically utilized call options to generate yield on underlying Bitcoin. So it was the first active covered call fund that was offered to the public at Wave Financial, that was launched in mid 2019. Because again, I was just really excited about the opportunity of the derivative space and the institutionalization of the cryptocurrency world. But by late 2019, I was really itching to get back and take some risk. So I really was enjoying the building of structured products, thinking through how we might tackle that market, but I was missing the risk that I was able to take at Ledger Capital. And so that led me to BlockTower. And so I ended up joining BlockTower in October of 2019. And for the last 6 months have been leading their trading efforts along with Ari Paul on the investment side. That's the quick and dirty.
That's a lot packed in a short period of time. Let me tell you. I mean, you couldn't have picked a more exciting time, I guess, to get excited about crypto. Prior to December 17, and it also, I like to think of the people who were in there prior and who are still here now. It's kind of like on the traditional side, right? I'm 44. I'm in my mid 40s, so. I always say to people, geez, portfolio managers, young ones come up to us and stuff like this when I was on the traditional side, and they hadn't been through 2008, right? So the old guard kind of didn't take them seriously. They're like, you're not a portfolio manager until you hit a 2008. I think a lot of us here today have lived through that. And it really, as someone who builds strategy, like yourself, or builds portfolios, that's an important thing, and it kind of toughens you up. To that end, this is the first episode post Halving. We actually had a couple portfolio managers on the weeks prior, coming up into this, saying, hey, what's it going to do, and what's it going to do right after. Nothing really transpired. It almost, as one PM said to us on last week's episode, it kind of was a nothing burger. I like that. I've used that about 40 times so far in the last week. And then, a lot of people were also anticipating mining sell-off post-halving almost immediately, let's say in the first 48 hours. We didn't see that at all. As a matter of fact, we've seen the opposite, where we've seen a very systematic rally since the halving right now, as well as, what's interesting enough is we're seeing a decoupling from traditional finance the last 2 days. Not that that's going to stick, but we're seeing down equity markets, up BTC. What are your thoughts on where we are in the Bitcoin market right now? And can you give us any foresight to what you think the remainder of the year is going to look like?
Sure. So I'm not one to predict prices, and as Bitcoin.
We're not going to ask you for a price, by the way. That's for sure.
And as you know, if you're in the Bitcoin markets, the cycles can be absolutely wild. So I completely agree with your point on 2017 was a crazy time to get in the market. The bear market hardens you. It teaches you a lot of different lessons. And the great thing about crypto is that you get these lessons in a very short period of time, right? Instead of having to wait a decade to experience what a cycle feels like, you experience it in 18 months. You get the full cycle. And then within the cycle, there are even miniature cycles. Like Bitcoin can go through a full equity cycle in 6 months, right? Where you have this markup of retail gets really bulled up. Well, first you have the smart money that gets really bulled up, then you have retail that gets really bulled up, then you have the blow off, and then you have everybody taking profits and chasing it down. And that happens so frequently in the cryptocurrency markets, and it's a great learning experience. So my view on the market currently is that we had the major event. And the way that I would frame the halving is as a marketing event. I wouldn't frame it as anything else other than that. So I think a lot of people get caught up in the details of what are miners going to do around halving, What is a supply shock going to be around halving? But I don't really view it that way. So from the supply side, the halving is actually kind of, it is a nothing burger. So inflation is being cut from 3% to 1.5%. That means that 900 less BTC are being sold a day, which in the grand context of things, when you have an asset that trades $1 to $4 billion a day in volume, that's kind of a drop in the bucket. So from the supply side, it doesn't really matter that much. From the mining side, what you have is you have really strong new miners that have just come out, S17s, and you've had a market that's known about the halving a priori for a very, very long time, right? So they've known that the halving is coming in 2020, and they've had time to prepare for it. And so what you really want to think about when you think about will there be sell-offs is who is going to be selling and what do their inventories look like. So right now, large miners still are making money on Bitcoin at these prices post-halving. Small miners with lower margins are not. But the small miners with lower margins knew before the halving that they weren't going to be making money post-halving. So generally what they've been doing is they've been selling into rallies going into the halving. And so when you actually get to the halving, by the time you get there, something's gone horribly wrong if you as a miner know that you are going to need cash to survive, but you haven't sold any Bitcoin and you just dump it right at the halving. So miners are smart. They don't think like that. And so all the worries of a dump right after the halving, I think are a little bit unfounded just based on the way that miners approach the market. Small miners will take profits as it goes up. Large miners don't really change their outlook. They might sell on rallies to recoup some cash just for upgrades, but in general, their habits don't change that much post-halving because the margins are still there. Okay. So my viewpoint was that the halving was this marketing event. And with the marketing event, what you want to do is buy the hype, sell the news, right? And that is kind of what happened. So we had that 20% peak to trough sell-off from 10K down to 8K. We're back at 9.1, which I think is indicative of the incredibly strong bid that is present in Bitcoin right now for a lot of unrelated reasons to the halving, including the macro environment. So one thing that I was looking for post-halving is that bid going to stay there? Because prior to halving, we had that markup from 6K to 9K, and that was an entirely spot-driven markup. Derivatives really played no major part in that. And my question was, is that a halving bid? Is that bid retail buying because of the halving, or is that bid going to persist after? And so that's really the question that you have to answer to figure out what's going to happen the rest of the year. And as of right now, it looks like that bid is there. And it looks like a lot of people are really worried. And it looks like a decent amount of people are off sides. And it looks like people don't really buy this rally.
You know, it's interesting. One thing we had during this halving that we didn't have in the past is open interest creating selling pressure. So there's all these different variables that have been thrown into this one.
So that's really interesting. Something that popped up recently is the fact that BitMEX is now trading at a discount to almost all other exchanges. And a lot of people looked at that and they said, okay, funding rates are negative at all the entire way up. Since March 12th, funding rates have been incredibly negative. And something that never fails to happen is that the market shorts the bottom without fail. I don't know why. I don't know why it happens. Probably just incredible amounts of fear, but the market aggressively shorts the bottom each time. So when we bottomed at 3K in 2019, funding rates were super negative. When we bottomed at 6K in January, funding rates were negative. When we bottomed here from 5 to 6K, funding rates were negative. It's just fear in the markets that drives this. But yeah, it's a pretty consistent pattern to basically just look for when the markets are incredibly fearful and bet against the herd, right? That's what you want to be doing in that scenario. But yeah, the open interest prior to March 13th or March 12th, Black Thursday, was a much bigger driver in the market. Right now, spot is the driver. Spot is in the driver's seat. Exchanges like Coinbase, exchanges like OKX, not their futures, but their actual spot markets. Those guys are the ones that are actually moving the markets. I don't expect that to last. I think this is a complete temporary blip, and that in 12 months, we're going to look back and say, yeah, okay, derivatives are driving the market again. But for now, paying attention to spot is paying attention to the market. Prior to that, I mean, 1 billion open interest in March was a great sell signal, right? So when we started getting up to like 1.2, 1.3, 1.4, that set up for that crazy excess drop that we saw on March 13th was purely because of all that open interest.
Gotcha.
Which causes a lot of volatility.
No, those are great points. And I think one thing that's worth going back to is the idea of the halving as a marketing event, and some of that you mentioned in the macro sense, where you have countries like Lebanon, as you recently noted in a research note, the currency crisis they're having there, Venezuela, Brazil, other places where inflation is running rampant, and now, despite huge demand for U.S. dollar that you've also mentioned in another research note having an impact on Bitcoin, there is going to be inflation in the U.S. because of central monetary bank policy and all of the dollars being printed. Can you tell us a little bit more about how you think that might affect Bitcoin and adoption rates going forward?
So I think something that gets talked a lot about is how does Bitcoin perform in a recession?
Mm-hmm.
And that's a difficult question to answer. But my general framing for this is that in an actual recession like 2008, 2009, Bitcoin will be sold off. It will not act as a safe haven. It will be hit the same way that all other asset classes are hit, and people will sell it to look for cash because cash feels like the only thing that's safe. But in an environment where you have low growth, but inflation, which a lot of experts are postulating that's the direction that the US is going to go in. First, a deflationary period, and then an inflationary period with low growth. That's an area that Bitcoin can really shine, purely because of its stable monetary policy and its ability to retain purchasing power in the face of supply, right? So while Bitcoin might be volatile, it can't be debased like fiat currency is being debased. And somebody that made note of this recently, as I'm sure a lot of people are aware, is Paul Tudor Jones. That was kind of the core of his thesis.
You're stealing our questions now. I mean,
yeah, sorry about that. But that was a core of his thesis, articulated in a great way. I encourage everybody to go read the note. But it was that Bitcoin could be a hedge against inflation purely because of these stable monetary characteristics. And you compare it against all other inflation hedges, and Bitcoin seems like it's a fairly decent bet because it has both stable monetary policy, but the upside of an early stage tech company because adoption is so small relative to most other inflation hedges. And so in an inflationary low growth environment with isolated pockets of risk like Venezuela and Argentina and Lebanon, I think that's a scenario that sets up for Bitcoin to do really well. Because what you have then is you have a country, an isolated pocket of risk that says that its citizens in that country say, we want to store our value in something. We want to get out of our local currency. We're worried about our local currency. We're not really too worried about the global state of things, right? We're not existentially worried about the global state of things like everybody was in 2008, 2009. And that can lead them to Bitcoin. Whereas if everybody was worried about the existential state of the financial markets, you might even just stay in cash because you're scared to put it in any asset because every asset's getting absolutely hammered. So I think right now we're actually set up. This is the setup for Bitcoin. If I was writing a script, I don't think I could come up with a better setup for Bitcoin, right? You have these massive macro pressures that drive the core narrative of Bitcoin. You have adoption from the highest level of macro managers. And you have this door that's now wide open for the rest of the world to come in and actually start buying Bitcoin because they're worried about fiat depreciation, right? It's like the script almost wrote itself.
Yeah. Going back to Paul Tudor Jones's note, glad you brought that up because we were going to ask about it anyway. So,
by the way, the letter is an interesting read. I definitely
it's a great read.
recommend. Yeah,
great read. He mentioned that he has as much as 2% of his net worth in Bitcoin. That automatically makes him one of the largest known whales in the cryptocurrency market. Do you think there's been a lot of debate over his motivations for putting that letter out at the timing that he did? Do you think he did that because he wants the rest of the macro world, his institutional world, to join him, or is he trying to help inflate the value of his holdings? Or he eventually sells them off?
Is he marketing? That's a great point, Ryan. Is he marketing so that he gets a market made on the traditional macro side of things, or what?
Yeah, so it's a really interesting question. I think there are kind of two reasons for it. One is everybody talks their book, right? You establish a position and you tell people about that position and how great it is and why it's so great. So from that angle, it's marketing. But I also think he kind of had to explain it, right? He has to explain it to people, just because he has shareholders, right? So he has people who he's investing on behalf of people, right? So you basically have to explain why you're buying this risky asset, and you have to give a really good framing for it. Otherwise, if you lose really big on it, then people are just going to call you crazy for buying this asset. And that's kind of where Bitcoin was prior to the Paul Tudor Jones note, right? Like if I'm a PM at a macro fund and my boss doesn't really like Bitcoin, I think it's going to be an inflation hedge. I can't really take out a flyer on it. I can't do that because what happens? I buy it, it goes up 2x, and I'm told, well, the volatility was really high. That was just a fluke. Bitcoin goes up, it goes down, it's a scam, right? And why did you buy this asset that's clearly not a macro asset, that's clearly not respected, right? And so what Paul Tudor Jones does is he comes out and he puts out this well articulated note. He establishes all the arguments in a way that every macro fund PM could understand, that every investor can really understand and really grok. And he opens the door for people to go buy it, because now there's an appeal to authority. However, efficient that is, there is now an appeal to authority that you can say, well, okay, if Paul Tudor Jones is buying it, is it really risking my career to buy it? He's already put his stake in the ground. I buy his arguments. Do you not buy his arguments? Right?
I mean, Avi, I do think that it was regardless if he has LPs to kind of communicate with, and it would somehow get public anyway. It's still a risk move, right? I mean, I'm sure he had a PR team saying, okay, what are the potential outcomes of me coming out and saying this? I do believe, and I want to hear your thoughts on this, I do believe that for all the talk, over the last couple of years with endowments and pensions and this and that, and, what gets floated around in the news with allocations, the story of Bitcoin resonates 1,000 times louder with an actively managed fund manager.
Yeah, this is the next question I was going to ask too. Like, is this the watershed moment? Is this when the institutions start jumping in? Is this when they start allocating more? And this is when you see the pensions and the endowments getting into the fund space more. Yeah,
it's too easy for an esoteric fund to say we allocated to this project or this protocol or this. But when an actively managed, high-profile, multi-billion-dollar fund manager says it, to me, that's a different story.
Absolutely.
Yeah, it's. I don't want to understate how important it is. I think in the context of macro fund managers and in the context of people that, could put a stamp of value in Bitcoin, Paul Tudor Jones is really up there, maybe save for Ray Dalio, as the guy that is well positioned to advocate for Bitcoin. I mean, if you think of all the major macro fund managers right now, Druckenmiller would be another good one, but somebody like a Soros doesn't really comment anymore. Somebody like a Buffett is not really known for his macro calls. So you're not going to listen to Buffett if he says inflation is coming. You're going to listen to Buffett if he says, I see really good deals in this equity market, right? Because he's a cash flow guy. He's a value guy. You have people like Howard Marks who write a lot about macroeconomics, but they're really distressed debt guys, right? At their core. So really, Paul Tudor Jones is kind of the macro guy other than Ray Dalio to put a stamp on Bitcoin. So I really do think this opens up a ton of doors, like you said. That being said, I don't want to predict the future, and I don't want to say that a bunch of institutions are going to come rushing in, because it takes a lot of time and every institution is different. But I think it radically increased the probability of institutions, pension funds, endowments, macro funds, all these guys entering the space and doing it quickly because they can't miss out on this environment. So that's really the key, because the way that Paul Tudor Jones framed it is that this environment, this inflationary environment, is the reason for buying Bitcoin. And so that kind of puts like a time limit on it, right? Because there's a catalyst, which means that there is only so much time before that catalyst gets priced into, right? And before Bitcoin goes up in response to that. So it kind of puts a time limit on it. And it makes me think that, yes, there are probably a lot of conversations going on right now. Again, there have been a lot of institutions buying, right? Like you have a lot of endowments that have already bought Bitcoin that are public, that are public about it, right? So it's just a matter of how widespread it gets, how quickly it goes, and then how much money is allocated. So for example, if you're a $7 billion institution, you might have allocated $5 million to Bitcoin. That means nothing.
Right.
But maybe now after this note comes out, you say, all right, I can allocate 100 million. Paul Tudor Jones is allocating 500 million. I can allocate 100 million, right? So I do think it opens up a lot of doors, and it makes me fairly bullish for 2020 and 2021. I think this setup, again, the next 2 years, the next 18 months really, are the best setup that I've seen for Bitcoin since I first got in 2016, because I'm seeing the right types of people get into the market.
Absolutely.
Wow.
And given this setup, yeah, the old axiom is always that cash is king. Cash is always king. Everything gets liquidated in a crisis. When there's a liquidity crunch, everyone goes to cash. Do you think at the point, maybe not in the near future, but at some point in the distant future or intermediate future, where the actual thesis, the digital gold thesis, finally comes true, and people stop fleeing from Bitcoin as another sellable asset during a liquidity crunch, and it becomes that de facto global trade currency, and maybe perhaps this was the beginning of that. Someone like Paul Tudor Jones getting behind it in the way he has.
So two things. One, I think even if Bitcoin was highly correlated with gold, and if it acted as digital gold, it would still sell off in a recession, right? Like gold sold off 30%. Peak to trough in 2008, 2009. I think that's just a function of if there's a liquidity crunch, cash will always be king.
Gold did at one point, like it did separate at the end of 2008, right? And it kind of went back and recovered, whereas the equity
did
going down. So
it did. But like at the beginning of a recession, even through the middle of a recession, I just don't think Bitcoin has the history to do well. I think people are still going to be really skittish. So if the world is selling off, Bitcoin is selling off, in my opinion. That being said, you can have Bitcoin is a fairly uncorrelated asset, right? During general amounts of time. Now, over the last 2 days, the S&P has sold off 4%, Bitcoin's up 3%, right? Over time, over the last 10 years, Bitcoin has been totally uncorrelated with the S&P. I'm just making the note that I don't want anybody to be disappointed when they buy Bitcoin. The world sells off and Bitcoin goes down too, right? Like I just don't want to get anybody in that mindset, because I think some people are, right? I had a lot of people message me on March 13th when the equity markets were selling off. And they're like, Bitcoin's down too. I thought it was supposed to go up. And I said, pick any asset under the sun and tell me what it's done over the last day, right? And Bitcoin's never going to be isolated from that until you reach a point where Bitcoin is used in everyday transactions or is like the currency of a country, which I think is, kind of far off. Until right. So from that perspective, I just want to frame it to make sure that nobody's upset. But I do think, Ryan, that over the course of the next 5 to 10 years, you're going to see Bitcoin act as a safe haven asset in times of isolated risk. It actually already kind of has. So Bitcoin rocketed really hard on the Iran missile strike news with gold. It acted as a safe haven asset alongside gold during that crisis. When Trump came out and he de-escalated the situation, Bitcoin immediately dropped with gold. And I think that was the first time I had ever seen Bitcoin act in tandem with gold that closely, right? It was a tick for tick correlation. And I think that that's only going to persist. And so I think in isolated pockets of risk, if the S&P trades down, like 5-6% from here, I can definitely see Bitcoin. I can definitely see Bitcoin going up. I can definitely see gold going up. And if we get the S&P trading sideways for the next 10 years, if we get a Japanification of the US economy, which I'm not calling for, I'm just drawing a comparison. If we get that scenario and gold is up, I think Bitcoin is up tremendously. I think Bitcoin is up tremendously in that scenario.
Avi, real quick though, with the you mentioned the Trump situation with the in the Middle East there. Why do you think that flight of safety happened for that incident? Any particular reason?
Yeah, I think it was gold correlation traders. So it's one of these things. So the markets are all about psychology, right? And so you can have a day that changes everything. You can have a week that changes everything. So Bitcoin exists, and if enough people just believe that it should trade with gold, then one day it might trade with gold. And that's just kind of how markets work. Like there's no reason really for gold to be a safe haven asset, right? Other than the fact that it has 5,000 years of history and humans agree to it. And so the same sort of reasoning is just coming to Bitcoin now, where if people view it as a safe haven asset, every time it reacts as a safe haven asset, that just gets solidified in people's minds, right? And so I think this was a combination of the move happening after hours, people looking for a safe haven asset, and gold correlation traders trading off of it, and enough people in the Bitcoin world viewing Bitcoin as a safe haven asset. And the reason I think it's now more likely is because it's happened once, right? So once it happens once, the next time people are looking for a safe haven asset, they'll remember the last time that Bitcoin acted as a safe haven asset, and it might happen again, right? And that's kind of how these narratives unfold. It's just that it's very rare to see these sort of things happen in real time, because it's very rare that we have a new type of asset come out of the ether. Like that just doesn't happen.
Sorry to cut you off, but another thing that's been happening that I think could also contribute towards that happening perhaps a little sooner. Instead of selling off Bitcoin for US dollars, a lot of people, traders, other market participants have been going into stablecoins recently, right? Necessarily leaving the crypto ecosystem, even if they're selling off Bitcoin. I mean, what is it? $10 billion in extra supply over the past 2 months. Do you think that if people increasingly, and market participants increasingly go into stablecoins versus into fiat, that could be more of an on-ramp towards them staying with Bitcoin in times of strife versus selling it?
Yeah, it definitely could be, and I think it lends sort of a stabilizing support to Bitcoin, because if people are not selling Bitcoin to US dollars and then not withdrawing those US dollars and they're selling it to stablecoins, then they're still contained within the cryptocurrency ecosystem.
Super use case.
Yeah, I mean, fantastic, absolutely fantastic use case. I think the growth of stablecoins in general has been kind of tremendous to watch,
right,
over the last 3 months. I mean, the amount of value that is now being allocated to stablecoins is massive. And I actually recently wrote a research paper with Max Bronstein about this stablecoin and what I call crypto dollarization, which I actually think was a term coined by a guy named Patrick Dugan on Twitter. But that concept is that crypto actually facilitates demand for dollars. So crypto right now, for a random person not in the US, is often the best way to get access to dollars, often the cheapest way to get access to dollars, and often the fastest way to get access to dollars. Now, this isn't true in a lot of Western countries and more developed countries, where some banks will actually allow you to withdraw dollars, or maybe you have certain accounts that can be denominated in dollars. But for a lot of people around the world, crypto is the easiest way to get access to dollar exposure, because all you have to do is buy Bitcoin and then buy a stablecoin. Mm-hmm. Or what you can do is use derivatives to mimic stablecoin exposure or to mimic dollar exposure. So let's say you're able to get some Bitcoin, you're able to get your hands on some Bitcoin in your country with your local currency, and you want to turn that Bitcoin into dollars. Simplest way to do it, you go on BitMEX, you deposit your Bitcoin, and you short 1x on BitMEX. So if you have $10,000 worth of Bitcoin, you short 10,000 contracts on BitMEX. Voila, you're suddenly exposed to dollars, right? And that takes you 3 minutes. No KYC on BitMEX, last I checked. So it seems to me that crypto is actually a really powerful driver for dollar demand. And as dollar demand in the world rises, crypto could have a lot of eyeballs on it. And so what you could see is a large amount of people flow into the crypto ecosystem purely to get access to dollars, but end up staying because they're in the ecosystem and because they see the benefits of the ecosystem, and they kind of get sucked into it. I say exposure to something, the more you get exposed to it, the more familiar it gets, and familiarity is the best thing for an investment, right? The more comfortable, the more familiar you are with Bitcoin, the more you understand it, the more likely you are to invest in it. And I think this kind of opens the door for a lot of new people to come into the ecosystem, this dollar demand.
Yeah, it's, you know, you go back, geez, 3 years ago when I got into the institutional side of this market, and we dealt a lot with Asian customers, funds, both esoteric and liquid, and Asian investors tend to be very coin native. You know, they don't want to leave that ecosystem. You know, to your point, stable coins have created that dollar within the ecosystem. I don't, from a funds point of view, from a treasury management point of view, I think more products will enter the system, whether it's tokenized treasuries or, you know, tips, strips, and whatever that funds need to do for cash management, because you can't currently cash management your fiat in a crypto account at a bank right now, like you can if you were traditional. I'm curious in your take on some of the new instruments hitting the market. Now, you go back to fall of 2018. That's really when funds started coming to us saying, hey, we're putting in derivatives, you know, BitMEX, Arabit, we're putting those into our portfolio, and they started becoming really popular. But now we have all sorts of wrapped instruments. We have a Bitcoin short token that's, you know, come out where you have downside exposure to BTC, you know, different things like that. What are your thoughts on that, particularly, you know, as supply, you know, as we reach the supply cap, you know, with BTC? Do you think these types of instruments matter? Do they expand exposure to the asset class?
Yeah, in theory they do. So in theory, you could have more aggregate derivatives exposure betting on Bitcoin than the market cap of Bitcoin. So in theory, yeah, they expand the value. For now, I think that derivatives are a really, really, really useful tool for the cryptocurrency ecosystem, kind of for two reasons. One is that speculation as a use case is a real thing, and derivatives encourage speculation and can actually bring in a lot of new eyes to the Bitcoin market. So if you're an FX trader, maybe now you're trading Bitcoin, and maybe now you spend a lot of time around it, and maybe you end up actually investing for the long haul. And that's enabled by a lot of these different derivative exchanges. On the flip side, they allow for the institutionalization of the asset class. So now you have things like options, you have things like volatility products, you have leverage tokens, you have all sorts of different ways to bet on Bitcoin and to hedge your Bitcoin exposure. So now miners use sophisticated options products offered by a variety of different firms to hedge their balance sheets, right? Or they'll just use futures. Maybe they'll use puts. You know, maybe they'll use covered calls. But there are a variety of different ways you can now hedge your exposure, and it allows institutions that don't necessarily want to experience the full volatility of Bitcoin to come in with dampened exposure, right? So if you just run a covered call portfolio, you're reducing your Bitcoin volatility, right? You're reducing the volatility of your return stream, but you're still getting access to the asset class itself. So with all these things in mind, I think Bitcoin derivatives and cryptocurrency derivatives are a net positive for the space. I think they're great, and I think they're going to continue growing. I think the options market is really going to take off in the next couple of years, and it's growing pretty rapidly right now. Actually, we just passed $1 billion in open options exposure recently. So we just passed that a couple of weeks ago or a week ago.
And then, do you think it's hampering the market? Sorry, Ryan. Do you think that the sudden growth of options derivatives are hampering the market, are dangerous to the market in any way right now?
So I don't think that derivatives themselves are dangerous to the market. I think what's dangerous to the market is the leverage that's provided by derivatives platforms. So what's dangerous to the market is a scenario like March 13th, where you have a bunch of really, really, really highly levered traders, right? The last time BitMEX released a leverage report, it said, this was April of 2019, I believe, 30x was the average leverage for a long and a short, which is nuts, right? And so the amount of leverage in the system that's given to traders without any recourse or without any margin requirements, really, I mean, 0.5% can get you 100x leverage. That's really where the danger is, because that's how you get super increased volatility, and that's how you get liquidation cascades like what we had on March 12th, which can turn a lot of people off from the system, right? So if you see an asset that drops 50% in one day, maybe you're less likely to invest. Actually, in all likelihood, you probably are less likely to invest. And so I think derivatives, I want to make the distinction, because you can offer derivatives without offering insane leverage. You can have a robust derivatives market with 10x leverage as your max. Totally fine, totally doable. It's just that the excessive amount of leverage in the system causes excess volatility and causes excess risk. And so, I mean, I would love to see leverage in the system come down. I would never advocate to take away that leverage, because I don't want to restrict anybody from what they want to do. But I think it would be great if the market got smarter and average leverage in the system came down. I think that with institutions coming in, that's going to be dampened, because what you're going to have is the ratio of leverage traders to non-leverage traders is going to go down significantly as new money comes into the system. Because the new money that I see coming into the system right now is not retail, is not your 100x levered punters. Those guys are actually leaving. So what I see coming in right now are longer term buyers, longer term spot holders, and more intelligent market speculators, which means that I think that volatility is going to go down over the next 24 to 36 months because of that.
It's interesting you mentioned that the derivatives market is playing a part in the volatility, which it obviously is. But there's a lot of people out there, a lot of experts and traders, who are saying that the post-halving sell-off, how small it was, can in large part be contributed to the floor created by the robust derivatives market. So I mean, it also has a major role in stabilizing things as well. So
kind of to the detriment of Bitcoin holders. So it's funny. If there were no futures market, I think Bitcoin price would be higher than it is today, purely because shorting is a way of creating supply, right? Like synthetically shorting is a way of creating Bitcoin supply and depressing the market. I think it's totally healthy that exists. It helps Bitcoin over the long run reduce its volatility. Like I said, derivatives are not the issue. It's purely leverage that's the issue. Right, like the introduction of derivatives to a market should lower volatility. The introduction of 100x levered derivatives to a market in which the majority of volume is traded on those instruments and the majority of leverage used is like 30x, that creates volatility.
Yes.
So there's millennials were never happier until they saw the 100x.
There's kind of this like, we really did. I can't talk down to millennials. I am one. Right on the edge, though. Right on the edge.
I think I'm more on the edge. I'm 38, so I'm at.
I'm on the other edge.
The younger edge is what you're saying.
Yeah.
No, I'm at the wrong edge of that.
But yeah, a lot of people look at the futures market and they say, well, the futures market should reduce volatility, and then Bitcoiners and cryptocurrency enthusiasts will say, no, clearly the futures market increases volatility. And I'm here to say the futures market reduces it, the leverage increases it. It's just that those two are intertwined right now.
So to be mindful of time, there's one question that we like to ask towards the end.
Sure.
You don't have to make a price prediction, of course, but where do you see Bitcoin at the end of the year?
I see it higher. If I had to, just to be clear,
Could you give me an exact dollar amount?
No. 300,000. No.
You and Tim Draper both.
No amount of sophistication can change the fact that all of your knowledge is in the past and all of your decisions are in the future. That is how I trade, right? And that's a quote from Ian Wilson about forecasting prices and forecasting
fortune cookie.
Forecasting the future. It's close to a fortune cookie, but it's one of those things that everything that I say I assign a probability to. I don't say this or that. So in my mind, I think there's probably like a fairly high chance that Bitcoin reaches its all-time high within the next 12 months. So by May 2021, I'd put it at like 60-40 that Bitcoin's at its all-time high, which I think is pretty big.
You heard it, Ryan.
You can make that bet on Deribit at a much lower probability than the one that I'm saying right now.
Put all your best clients in it.
Indeed, to Deribit I go.
Avi, that's awesome. Thank you. Go ahead, Ryan. I interrupted.
No, not at all. But yeah, thank you very much for joining us. It's been a
yeah.
We're going to have you back, obviously. I mean,
I loved it. This was a great conversation. Thank you guys for having me.
Thank you.
Thank you so much for taking the time. Really appreciate what you and BlockTower are doing in this space. Love seeing you guys around at all the conferences. Unfortunately, that has been happening lately. So, but hopefully life returns to normal, and you and everybody at the firm stay safe.
Indeed.
You too.
All right,
Take
guys.
care.
Thank you.
Thank you.